Hello friends, in this video we are going to discuss the AS1, that is the Accounting Standard 1 issued by the Institute of Chartered Accountant of India. The AS1 is related to the disclosure of accounting policy. Whatever the information presented in the financial statement shows the financial position of the organization. Further, whatever the financial statement I prepared shows the profit or loss of the organization. However, such profit or loss of the organization is affected by the accounting policy selected by the organization. Now, the question may arise that what is the meaning of the accounting policy? So, the accounting policy means the accounting principle or method of applying those accounting principle by organization in preparation of the financial statement. So what is the meaning of accounting policy? Accounting policy is the accounting principle and method of applying those principle for the purpose of preparation of financial statement. So the different organization will follow the different accounting policy. So for the purpose of better comparison and for the purpose of better understanding of the financial statement, the disclosure of the accounting policy is required. Further, such disclosure of accounting policy is also required by law in certain cases. Now, what is the purpose of this accounting standard? The accounting standard 1 is issued for the purpose of better understanding of a financial statement by establishing the practice of disclosure of the accounting policy followed by the organization. Because for the purpose of comparison between the two financial statement of two organizations, or for the purpose of a comparison of a financial statement of a two different periods, disclosure of accounting policy will be helpful. Because if a different accounting policy will be adopted by a different organization, such comparison will not be meaningful. So for the purpose of meaningful comparison of a financial statement, the disclosure of an accounting policy is required. Now, certain fundamental accounting assumptions. So there are three fundamental accounting assumptions. First is the going concern, second is the consistency, and third is the accrual. Now let us discuss one by one. What is the meaning of a going concern? The financial statement are prepared with the assumption that the organization has neither intention to curtail down its majority of a operation, or it has no any intention to shutting down or reduce the majority scale of a operation. So the financial statement are prepared with the assumption that organization will run in a better future for a foreseeable future period. It has no any intention to curtail down or shutting down its business. So this is the first major fundamental assumption. Second is the consistency. So it is assumed that the accounting policy are consistently followed from one period to another period. No frequent changes are accepted. So whatever the accounting policy is adopted by the organization, such accounting policy is consistently followed by such organization for the different period. So there is no frequent changes in the accounting policy. This is the second assumption. Now the third assumption is the accrual. So what is the meaning of a accrual? So whatever the revenue and a cost are recorded when they are earned or incurred. Same for example, you have made the sale to your customer as on 31st March. That is the last day of their financial year. So whenever you have made the sale, as and when the risk and ownership of the goods is transferred, and it is that you have not received the money for the purpose of such consideration of sales from the debtors, even though revenue is recognized because sales is already made for a particular period. So revenue is recognized when they are earned, though money is received or not. Further, the cost is recorded as and when incurred. Same for example, if you have paid the salary of a March in the month of April, that is in the next financial year. However, such salary is related to the previous financial year, that is for the purpose of March month. So such salary is recorded on an accrual basis because it is incurred in the month of March and not in April. So whatever the revenue are realized, that is recorded as and when they are earned, though not necessary in a monetary term, that is money is received, and whatever the costs are incurred, that are also recorded for a particular period in which they are related, though necessary not actually paid in cash. So this is the accrual. So what are the three fundamental accounting assumptions? Going concern, consistency, and accrual. Now, there are a different area in which there are a different accounting policy are possible. Same for example, method of depreciation. You can follow the WDV method or you can follow SLM method. So these two methods are possible. So there are different accounting policy for the purpose of depreciation. Same for example, valuation of inventory. You can follow FIFO method. You can follow average method. You can follow LIFO method. LIFO method is not allowed by AS2. So there are different accounting policy for the purpose of valuation of inventory, for the purpose of treatment of goodwill, valuation of investment, retirement benefit, recognition of a profit on a long-term contract, valuation of a fixed asset, treatment of contingent liability. So there are a different accounting policy, and such accounting policy are followed by the various organizations. So these lists are not limited. There may be a many area in which the different accounting policy may be possible. Now, what should be the consideration for the purpose of selection of the accounting policy? So what the organization should look after for the purpose of selection of a accounting policy? So what is the primary consideration? The primary consideration is that the financial statement shall present the true and fair picture of the financial position. So what is the fundamental is here? The financial statement should show the true and fair picture of the financial position. So what are the considerations for the purpose of accounting policy? Prudence, substance over form, and materiality. So what is the meaning of a prudence? So uh, all of us know that the future are uncertain. We cannot predict the future. So in view of the uncertainty of a future event, profit are not anticipated but recognized only when they are earned, though not necessary in cash. So profit are recognized only when they are earned on an accrual basis. However, provision is made for all non-liability and losses, even though amount cannot be determined with certainty and represent only estimate. So what is the meaning of a prudence? Profit is recognized only when they are earned. However, loss or expenditure are recognized in the books of account even though it cannot be determined with certainty or it can be made only with an estimate. So what is the summary? Profit cannot be anticipated, however the loss and expenditure can be anticipated and provision can be made in the books of account. Next one is the substance over form. The accounting policy and a presentation of a financial statement should be governed by substance and not merely by legal form. So same for example, a person has made agreement to sell for the purpose of a property as on 21st March 2020, and he has given possession of the property. He has also received the money for all the property, that is all the consideration for the purpose of sale. Possession is transferred, money is received, only the sales deed is not made. So here in terms of the legal term in the register record, the property belongs to the original organization, because in the sale deed is not happen. However, substance, for the purpose of substance, the property is already passed to the buyer. We have already received the sale consideration. Only the sale deed is pending. So we have to look here the substance over form. So we can here recognize the sale of such property even though sale deed is made in the next financial year. Now, materiality. The financial statement should disclose all the material item. What is the meaning of a material item? So the item, the knowledge of which might change the decision of the user. Same for example, if particular item A is not disclosed by the organization and you can make a decision, same for example X. If such item is disclosed by the organization, then you can change your decision from X to Y. Then it can be considered as a material item. So what are the three major considerations for the purpose of selection of an accounting policy? Prudence, substance over form, and a materiality. Now disclosure of an accounting policy. So this is the main portion of this standard. So this standard requires that the organization should disclose all the accounting policy adopted by the organization in a preparation and a presentation of a financial statement, and such disclosure should form part of the financial statement. So it is a compulsory for an organization to disclose all the no accounting policy adopted for the purpose of a preparation of a financial statement. Further, for the purpose of a better understanding, such policy should be disclosed at a one place and not scattered down to the page by page. So all the accounting policies should be disclosed at a one place. Further, any change in the accounting policy uh, should be disclosed and which have a significant effect due to change in the accounting policy must be disclosed. Further, the amount by which the financial statement are affected due to change in the accounting policy. So the amount, you have to quantify the amount by which the financial statement are affected due to change in the policy should be disclosed. If such amount are not ascertainable, wholly or part, then the fact should be disclosed that there is a change in the accounting policy which has a significant effect. However, we cannot quantify the amount. So such fact should be disclosed. Further, if a change in the accounting policy has a material effect on the financial statement of a current period as well as the next period, or same for example, it does not have a significant effect on a current period but it may have an effect in the future period, then such fact should be disclosed appropriately in the financial statement. However, suppose the organization had done something wrong, he have disclosed the same, it may be a remedy. No, disclosure of a accounting policy is not remedy for any wrongdoing. Please remember. So what is the summary? All the significant accounting policies should be disclosed for the preparation of a financial statement. Such disclosure are form part of the financial statement. Such disclosure should be made at a one place. Any change in the accounting policy should be properly disclosed. Any change in the accounting policy which has a significant effect, the amount shall be quantified and it should be disclosed. If amount is not ascertainable, it the fact should be disclosed. If it has a effect in a future period, such fact also be disclosed. Now the most important is the fundamental accounting assumption, going concern, consistency and accrual. If they are not followed in the financial statement, then such specific disclosure is required. If fundamental accounting assumptions are not followed, then only the disclosure is required. Otherwise, we shall assume that the fundamental accounting assumption, that is a going concern, consistency and accrual are followed. If this fundamental accounting assumption, going concern, consistency, accrual are not followed, then specific disclosure is required. So this is the disclosure, this is the discussion on the accounting standard 1. Thank you.